Thanks very much. Thanks to Zach for inviting me out here, and it's kind of interesting talking at an entrepreneurship conference because in many ways, after I left university, I had no designs on being an entrepreneur or starting my own company. I actually went to work for the largest company in Canada, and kind of growing up, never really had designs on being an entrepreneur. And in many ways, I think I'm kind of like an accidental entrepreneur. Even though I heard in the intros the term entrepreneurial mindset, and I think that's actually very important because whether you've started your own company or whether you're working at a large company, I think an entrepreneurial mindset obviously is something that's very important. I'll talk a little bit about IEX, but I think it's really important. Anytime you're starting a company or you think about starting a company, I think it's really, really important for you to have experienced the problem or experienced the inefficiency that you're trying to solve. Entrepreneurship has many ups and downs, and I think in those down moments, if you don't have an absolute resolve about the product that you're building or the service you're providing and its necessity in the world, there are many times that you'll probably end up quitting. So I think experiencing the problem that you're trying to solve or the inefficiency that you're trying to solve for is extremely, extremely important. Not just what people say, not what you read, but you have to actually live it. So my background is I ran trading at the Royal Bank of Canada, stock trading, so I was in the equity markets, born in Canada, grew up in Toronto, and moved to the United States in 2002. Starting around 2006, the stock market started to change. And my job at RBC was trade on behalf of mutual funds and hedge funds. So they would trade in typically large size, and they'd give me an order and say, hey, buy 100,000 shares of GE. So in 2006, I could go onto a screen. It's a Bloomberg Reuters terminal. I think we pulled this from Yahoo or Google Finance. And you see, if I have 100,000 GE to buy, you can see 100,000 shares offered at 25.01. In 2006, I could go into my computer, type 100,000 buy, 25.01 go. I'd buy 100,000 shares of GE. But in 2007, I would try to do exactly the same thing, and I'd only buy 80,000. In 2008, I tried to buy 100,000, and I'd only get 60,000. And in 2009, I tried to buy 100,000. I'd see it on my screen, and I'd only get 50,000 of what was there. It drove me absolutely crazy. And I lived with it for 2 years. So again, this idea is not like it happened to me once and I ran out, kind of raving mad. But it happened to me for 2 years. I asked a lot of questions. No one could ever tell me what was happening. I got lucky in many ways at RBC in the fact I had 7 jobs in 12 years at RBC. So they bounced me all over the place. So I guess in a way it's intrapreneurship at a large company. They offered me the opportunity in 2009 to go and run electronic trading, which meant I was going from managing a group of human traders, people, physically, phones, computers, et cetera, to managing a group of computer engineers, network engineers, people that were designing algorithms that the traders would use. To me, that actually became a very interesting way, number one, to just broaden my skill set. I had been doing trading for a decade, but also to actually get a better understanding of how the stock market worked. Because at the same time that this was happening to me, I started to read more about things such as high-frequency trading and the fact that greater than 50% of the volume in the US equity markets were traded by computers who didn't understand fundamentals of companies. So I took the job in 2009 in electronic trading, and what was explained to me was actually quite interesting. The 100,000 shares that you see on your screen, GE lists on the New York Stock Exchange. When you turn on CNBC, you see a bunch of people running around on the floor. Actually, no trading happens on the floor of the New York Stock Exchange. All of those orders are beamed out to a data center in Mahwah, New Jersey. That's where the trading happens. So the 100,000 shares that I saw was actually an aggregation of different exchanges. There were 13 different exchanges at the time in 2009. 5,000 here, 10,000 there, 20,000 here, adding up to 100,000 shares. The 4 biggest exchanges, BATS, Direct Edge, NASDAQ, and New York, were all actually located, conveniently, you'll find this kind of funny, in different data centers. So let's pretend 25,000 shares was offered on each, all at the same price. RBC was downtown Manhattan. I type in buy 100,000 GE, enter. And what the technologists and the computer engineers explained to me was that one press of the button actually created 4 messages. We blasted them out, and they arrived at different exchanges at different times. BATS, we arrived there first simply because BATS is in Weehawken, New Jersey, right on the other side of the Lincoln Tunnel. So our messages would all go up the West Side Highway from downtown, out the Lincoln Tunnel. The very first exchange it would arrive at was BATS. Next, Direct Edge in Secaucus. NASDAQ isn't in Times Square. It's in Carteret, New Jersey. That's just a billboard that you see outside there. And New York Stock Exchange isn't downtown on Wall and Broad. It's actually a data center at Mahwah, New Jersey. They spent $500 million building it. The difference between getting from BATS to New York Stock Exchange at the time in 2009 was 2 milliseconds. So to give you some concept of 2 milliseconds, when you blink your eye, that's 300 milliseconds. So 2 milliseconds is incredibly fast, or so I thought. I hired a guy at IEX. The one thing you'll know as you build companies is if you don't know something, try to hire someone who does know it. At RBC, I hired a guy by the name of Ronan Ryan, and what Ronan had done is he built networks for high-frequency traders. He had no idea how to trade, but he definitely knew a lot about architecture and engineering. What he explained to me was, I got bad news for you. I have just finished building networks that can get me from BATS to New York in 476 microseconds, 4 times faster than RBC could get there. So this presents a problem. Number one is that the second that our order, something that I believe to be simultaneous, me trying to buy 100,000 shares, actually is a series of events measured in microseconds. What would happen is they'd pick up a signal at BATS and say, all 25,000 shares of GE was just bought on the offer. Now they're racing me to the other exchanges to do one of two things. Number one is they want to cancel all of their sell orders in GE, because I don't want to sell anymore because here comes a big buyer. But also, two, buy as much GE as I can to sell back to the buyer at a higher price, which is really what happened, which is what led to me getting 50 to 60% fill rates. And the funny part about this is people say, oh, the stock market, it's a coincidence. There's a lot of things happening. But what I would do is, to anyone there, I'd prove them wrong. I'd say, OK, I'm about to buy 60,000 GE at 25.03. And I'm not going to press this button for 5 seconds. And if while I'm waiting, GE's trading along, it's going along, you're right. This is just a random market, lots of people trading. Nothing would happen until I pressed the button, which meant I was not part of some random market. I was the news. I was the event. The fact that I wanted to buy those shares is the reason people were canceling and buying shares ahead of me to sell back to me at a higher price. So the very first thing I say to Ronan, he explains this to me, I say, well, can we get faster? And the funny thing he said is, he said, we are the Royal Bank of Canada. We will never be faster than anybody, right? So I said, OK. I said, that's fine. I said, well, what can we do? And we came up with this idea to get slower, which means actually send the order, theoretically, it was a little harder than this, but I don't have much time, send the order to New York Stock Exchange first, send the order to BATS last, and try to arrive at all exchanges as close to simultaneous as possible. That's very, very hard to do because latency changes depending on, at the beginning and ends of the trading day, 9:30 and 4, the message networks are jammed. It's slower. Latencies are slower. Middle of the day, they're faster. So this is actually a very hard thing to do. But we got the exchange variance down to 290 microseconds. Based on the laws of physics, it then became impossible for a high-speed trader to pick up a signal at BATS, race us to New York. Our fill rates went to 100%. This was me experiencing the problem and actually understanding what it takes to solve the problem. Now, the problem with this is that we built this at the Royal Bank of Canada. Every mutual fund that I walked into, I said, well, if you try to buy 1 million shares of Bank of America on the offer, how much can you get? And a variety of different firms said 20, 200,000, 300,000. I said, I'll get you all million. And they would say, give me the product. RBC went from number 19 to number 1 in US electronic trading in 1 year. The problem is this. Our market share was capped at 5%. We went like this, and then we went sideways. And the reason for that is that people say, well, I want to trade with Goldman Sachs. I want to trade with Morgan Stanley. I want to trade with Credit Suisse. And for a variety of reasons, all of them valid, research, banking, prime brokerage, et cetera, it was put best to me where one big client called me and said, we love what you've done. We love this product. You've only solved 5% of my trading problem. I was like, what are you talking about? He's like, that's the amount of trades I can send to RBC. So at this point, I guess, this is where you go from never wanting to start a company to actually strongly considering starting a company, because what we realized is that solving it at RBC only solved a very, very small part of the problem. We thought long and hard about what to do, and the only best next thing to do, in our opinions, was to quit our jobs at RBC and actually start our own stock exchange. If you think about it, a lot of people get mad at high-frequency trading. High-frequency traders are just capitalizing on a broken system. Ask yourself the question, how does a high-speed trader get from one building to the next in 476 microseconds? And you start to realize that the stock exchanges are not what you think they are. They're actually data centers. And if you do a little bit of research, what you'll find is that stock exchanges sell fast data for hundreds of millions of dollars. If you want to know the price change of a stock first, pay them for it. On top of that, once you have this advanced information, if you want to trade on it before anyone else has access to that information, you can pay to put your servers right in the same building as the exchanges and trade hundreds of times, thousands of times before the last person in line figures out that the price of the stock has changed. That is a massive problem. So we said, you know what? We're going to start our own stock exchange, and we're not going to do that. So we had this idea, let's start a stock exchange, but what does that even mean? I actually, it's funny, we were sitting in a room, someone says, why don't we build our own stock exchange? And I asked that exact question, what does that mean? Like, how do you build a stock exchange? But we had this idea, let's build a fair, simple, transparent market. There were 9 of us in a room that were crazy enough to quit our jobs and do that. The problem is, we had no money. There was a group of mutual funds when I was at RBC that said, yeah, this is a great idea, you should do this, you should do this, you should quit your job. And the stupidest thing I ever did was quitting my job without getting it in writing that they would fund it, because they didn't. One of the mutual funds, Capital Group, said, you know what, we'll fund this if you get 9 other buy-side firms, asset managers, to come alongside us. It took us a very long time to do that. In the meantime, all the banks and brokers wanted to fund IEX. Wall Street likes to fund its own disruption. The problem with taking money from the brokers, they're great partners, right? They're huge companies, but there's a conflict of interest, number one. And number two, if we're owned by RBC, then Goldman won't want to trade on our exchange. If we're owned by Credit Suisse, then Morgan Stanley might not want to trade on our exchange. And that's why you actually have 50 different stock markets in the United States, because each person tried to solve the problem themselves. Limit scalability. Exchanges were very interested in getting this team that uncovered all this research. The problem is they don't want anything to change because they're making a huge amount of money from the way the system exists. They want to maintain the status quo. So lastly, we wanted to get it from mutual funds. End users of the market, they're aligned with our interests. The problem is no asset manager had ever funded a private stock exchange. 50 of them are out there. They're all owned by brokers except for New York and NASDAQ, which are public. It took us 9.5 months to raise this money. So basically, we are turning down money for 9.5 months solely to get alignment with our long-term vision. If we accepted money from the wrong parties, I would not be standing on this stage. So it took us 9.5 months to raise our first round, but we stuck through it. Our investor group, Capital Group, Mass Mutual, Franklin Templeton, Bill Ackman's fund, Pershing Square, Greenlight, et cetera. Also Spark and Bain Capital Ventures came in on our last round. All end users of the market, but none of them can trade directly on our market. We separated the conflict of owning something and trading there directly, which is one of the biggest conflicts in our industry right now. But taking how much money you raise is not nearly as important as who you raise it from, especially in an industry like Wall Street. So a couple quick things. We hired people from exchanges. We hired people from the SEC. The benefits of being close, co-locating your servers right next and paying millions of dollars to do that, we actually negated all of that by coiling 38 miles of cable in a box and sticking that in between everyone. We essentially created a speed bump to slow down the fastest traders, to create a level playing field for all investors, fast or slow. Got lucky enough, in a way, that Michael Lewis, the author of Liar's Poker, Moneyball, Big Short, Blindside, was writing a story about a high-frequency trader who got thrown in prison for taking computer code. And his lawyer called Michael Lewis and said, my client got thrown in prison, and no one even understands what he took. And this clearly is something that a writer like Michael Lewis gets interested in. One way or another, he came to us asking for background to write a story about somebody else. And as he learned more about this crazy group of people that quit their jobs to start a stock exchange, we ended up becoming the subjects, and I ended up becoming the main character of the book Flash Boys by Michael Lewis. It was featured on 60 Minutes, and that kind of shot us out of a cannon in a way. And again, this idea about being an accidental entrepreneur, I think, is entirely true. Michael Lewis actually said the hardest part he had in writing this book is that he found me very boring. So he's meeting. We have a lot of characters at IEX and all sorts of different kinds of folks. We're majority of our employees are tech employees. But he kept coming back saying, I'm having a hard time writing about you. And so he went out. He asked to go to Toronto to meet my mom, my stepdad, and have dinner with 5 of my childhood friends, and which was obviously a nerve-wracking experience. And Michael Lewis flies back and he sits me down and goes, I think I figured you out. I was like, oh boy, here we go, right? And I said, okay, well, what'd you figure out? He said, you were never looking to cause a fight, which is actually entirely true. I was not, I've spent my entire life trying to get along with people. He said, you were never looking for a fight, but the fight found you, and you just decided to fight back. And I think that's a very accurate description. I never dreamed of getting into a war with people on Wall Street. It was just never in my character. It was never a goal of mine to do that. Situationally, though, this is where I am. And in a way, if I hadn't experienced the problems that we're trying to solve, and I know with results, I've testified in front of the Senate, I've done a number of different things. I'm speaking from experience every time I talk to people and say there are problems in the stock market. I've lived through them. So I think that's a very, very important thing. Let's talk very quickly about this idea of disrupting Wall Street for those who are thinking about getting into fintech or getting into financial services. There's a very interesting cycle that's happened. It always starts with a scandal, and that scandal creates headlines, people get really mad at it, and ultimately it leads to regulation, because the regulators have to respond to scandals. If you look at the history of regulation, they've all been in response to a scandal one way or another. There's no such thing as a perfect rule. Regulation always has loopholes. Always. That's why there's lobbyists to create those loopholes. Regulation always has loopholes, which means that when these loopholes are created, it gives the opportunity to exploit the loopholes. The exploitation gets so egregious that it leads to the next scandal. And we go around and around. And this is like literally, go back 100 years in the stock market, and you can line this thing up according to this cycle. Now, there's two big problems with this, and I think this relates to entrepreneurship. Number one is that scandals decrease the amount of talent that want to work in your industry. People that, I'd have to defend Wall Street many times. I go home for Thanksgiving, and people would be yelling and screaming about I ran a trading desk during the financial crisis. RBC wasn't that involved in it, but still, scandals demotivate people to work in certain industries. The other part is regulation. As the walls of regulation come up, the barriers to entry get much harder. It makes innovating harder in highly regulated industries. Much, much harder. Which actually, in a weird way, as regulation builds these huge walls, the only people left inside are the people who have caused the scandals in the first place, which leaves it up to them to disrupt themselves. So that's a problem. In many ways, IEX is a free market solution. I actually took a bunch of stuff here, but we could have gone out and picketed down in DC and yelled and screamed and wrote papers to the SEC, et cetera. But we said, you know what? We're going to create a market-based solution to known loopholes in the market. So in many ways, a market-based solution to a loophole prevents exploitation. That's what we're trying to do. So many companies, so many industries are about making life more efficient. So what we're trying to do is we're actually a market-based solution to prevent exploitation of a known loophole, which hopefully prevents the next scandal, which hopefully prevents the next set of regulation from being written. And by doing that, you actually increase the amount of talent, you increase the amount of innovation in our industry, and it creates a new cycle, people attacking problems instead of exploiting them. So in many ways, part of what we're doing is building a fair, simple, and transparent stock market. But the other thing that we hope we're doing is we're starting a wave of innovation in financial services about solving for loopholes and not just exploiting them, which leads to the next scandal. And I don't think we're taking questions, so I think that's the end of my talk. All right, thank you.